Hi, I'm Max Keiser. This is the Keiser Report. Man, things are looking weird, Stacy.
Right. I like to call this a blizzard dream. We don't know whether there's inflation, deflation, hyperinflation, hyperdeflation. Many of our guests say it's inflation and it's heading for hyperinflation. Others say it's deflation and it's going to head to hyperdeflation, or it's deflation and heading to hyperinflation. So we saw similar when in our early days of Keiser Report during the last financial crisis, and I think it's the same sort of thing today. And one of these days, one of these boom and bust cycles will collapse the whole system. That's my opinion. Whether or not it's this, we don't know. So we're going to look at the information. Everybody knows that house prices are soaring out of control in America, across America. It's amusing to watch your house price theoretically go up $2,000, $3,000, $4,000, $5,000 every day. Used car prices, as Wolf Richter said on a recent episode here, that consumers are willing to pay the increase, that he, as a former auto dealer in that sector, like he's never seen anything like this, nor have any of his contacts. And that's the most important thing, according to the central bank and inflation, is whether or not consumers are willing to pay those increases in prices, right? They don't step away. They keep on demanding the product, even though it's going up in price. And stock markets, of course, continue to hit new all-time highs. So that's the inflation side. Then we have the deflation side of the derivatives, that there are unknown quantities out there.
Well, let me explain everything.
Go ahead.
In 2008, global financial crisis, we had a global credit freeze. Global economy suffered cardiac arrest, effectively died. Mm-hmm. In response, that's called deflation. When you have an event where bonds, for example, become worthless, and you would call that deflation. And in response, the central banks flooded the system with money, fiat money, and they lowered interest rates to zero. And this has caused a lot of bubbles. And because we live in a financialized world where everything is traded and everything's commodified and commoditized and traded on exchange, those bubbles can appear everywhere, including food and energy occasionally. So a lot of that bubble is in food prices, and it goes up and people say, look, inflation. But it would be a bubble in food within the context of a secular deflationary collapse. The reason I can say that with some confidence is that we have not seen any bubble in wages, right? Everything is subject to a bubble except wages, because there is no actual inflation as defined by an accelerated economic activity or business cycle that would precipitate things like rising interest rates, rising wages, et cetera. No, we have structural collapse. We have lots of money printing faster than the system can collapse. For every $1 trillion in bonds that are at threat of collapsing, the central banks will inject $5 trillion worth of fiat money, and the interest rates are near zero. And those who can, the speculators, and those are now the ruling elites of the world, are the speculator kings. They can create bubbles. It could be used cars this week. It could be food next week. It could be islands somewhere in the Pacific the week after that. Those are bubbles within a secular collapse. And ultimately, when the everything bubble collapses, then we have the realization that the economy died in 2008. We just haven't buried it yet.
Right. And that wage inflation story is entered into in this JP Morgan report recently, where they're predicting 3% inflation for the next 10 years. They're outside their peer groups. JP Morgan, Goldman Sachs thinks it's not going to hit 2% at all over the next 10 years. But JP Morgan's predicting it's going to run higher. And it's obviously not because of wages. Wages are not going up, but their income is going up. The ordinary American's income has gone up dramatically in the past year because of all the stimulus, all of the enhanced unemployment benefits. All of that has caused their wages to go up. Americans unleashing pent-up savings could drive up inflation and rattle parts of the market, JP Morgan's chief strategist says. Karen Ward said in an online presentation this week that JP Morgan estimates Americans have built up extra savings worth around 8% of U.S. GDP during the COVID-19 pandemic, when their spending options have been limited. Ward, a former top economic advisor to the UK's finance ministry, said she thought most of this would be unleashed in a spending spree when combined combined with Joe Biden's $1.9 trillion stimulus bill worth around 9% of GDP, that is likely to push inflation higher, she said.
Right, as you point out, those aren't wages.
No.
That's income. So the income through transfer payments, through money printing.
Yeah.
Because the economy died in 2008 and it's being kept animated, like an animated corpse with electric shocks, with money printing. And this is causing bubbles. So used car prices are in a bubble, not because wages are growing and that there's inflation and there's GDP growth and there's any hope of paying down the national debt. Those hopes have been dashed. That's never going to happen. But we do have these bubbles within the collapsing global economy, and the acceleration of that crash is increasing, which is now contributing to geopolitical tensions. You've got this new Cold War situation bubbling. That's because the economy died in 2008.
Though it just dawned on me when you said the transfer payments, it could just be a situation whereby you talk about the geopolitical tensions, and we've talked about the Thucydides trap, and that the conflict emerges when a rising power overtakes a declining power. That happened to Europe in the past as well. So, we could just becoming more French, more and more people, there's mass deflation across Europe as well. There's a deflationary problem there, but because wages aren't rising, wages don't go up, but there's huge transfer payments from the government. It seems like markets accept that in some way, though JP Morgan does point out that the first quarter to 2021 has been the worst bond market since the 80s. So they're suggesting that's the bond market thinking there's going to be pricing in huge inflation. So
right. Well, the bond signals on the 30-year bond clearly shows a downward trend. It's currently 2% yield on the 30-year, and there's room for it to go to 0.25%, 25 basis points. So we'll see about that in the next 9 months. If U.S. is becoming more like French, then the switch psychologically, in America, you work to take time off, and in France, you take time off, and work is something that just allows you to take more time off. Right? It's a completely different psychology. We've lived there for many years. We know how that goes. In the U.S., you get 2 weeks vacation, and many Americans don't take the full 2 weeks. In France, you get 8 or 9 weeks vacation, and that can be stretched out to 12 or 13 or 14 weeks vacation. And that's the psychology, is that work is a necessary evil to take time off.
Well, again, the psychology changes, and that's the thing that central banks in particular worry about, and investors. So we have, as we mentioned, you have transfer payments that were huge last year, and whether or not, a Biden administration will be able to roll that back, it's unlikely, right? Once you're getting all that free money, who wants to take a 20% cut in their pay, their income, essentially? And Michael Burry, the famous hedge fund manager who is a subject of the movie The Big Short, who shorted the housing market when the subprime mortgage market collapsed and caused a global financial crisis. Well, remember, he said that we're in the beginning or the end of the Weimar stage, like the end is the last year of hyperinflation. So he's saying, it went for 9 or 10 years and you saw a lot of inflation and a lot of booming stock markets and booming property markets as the investors, the psychology was changing over those 10 years, getting ready for more and more inflation until it collapses, their whole faith in it. Investors have put more money into stocks in the last 5 months than the previous 12 years combined. In raw numbers, $569 billion has flowed into global equity funds since November, compared with $452 billion going back to the beginning of the 2009-2020 bull market. Again, obviously there's somebody on the other side selling it to these investors, but a lot of people are flush with a lot of cash, but it's also that psychology that Michael Burry talks about of the Weimar. If you can control this inflation, if you could do something, if it gets too hot, Brand Bernanke had argued they could just stop it in a few minutes by raising interest rates, but whether or not they could do a Paul Volcker sort of situation, as happened in 1980 when he ratcheted up interest rates to near 20%, we'll see.
No, they can't. And stocks are clearly in a bubble. And as a result of all this money printing, transfer payments, and ease of access through apps like Robinhood and others, you've got folks who are getting money from the government and going right into stock market speculation and buying options and going on margin. And the margin pool has never been higher. Not even before the crash of 1929 did you see as much margin on a percent basis than you do right now. It's the highest percent-based margin fueled stock market ever in history. And again, that is a function of a bubble within a collapsing system. When those bubbles start bursting, pop, 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 then you have the recipe for a global conflict, sadly, because there will be no way for one country to survive without taking the resources of another country.
Well, we see that in this final headline here from Bloomberg. And in terms of, Great Depression sort of times and blizzard dreams of negative rates and negative oil prices and crazy stock signals, price signals and stuff like that. Well, we've always had a beggar thy neighbor, right? Every nation, of course, tries to survive the best they can. And that includes the weapon of beggaring thy neighbor. And if you have the US dollar as a reserve currency, if you get to print it, then you can export inflation or import inflation, whichever one you choose. The global middle class shrank last year for the first time since the 1990s, with about 150 million people slipping down the economic ladder. So this is a new study out, and it shows that 150 million people tumbled out of the middle class.
Right. So the rise in the bubbles, like the stock market, are masking the fact that the global middle class is shrinking. It's neo-feudalism, as we've called it before. It's this barbell economy where it's extreme concentration of uber wealth at the very tippity top, and everyone else is essentially hand to mouth and one paycheck away or one transfer payment away from being homeless. And there's absolutely nothing in the middle. But that's by design, by the way, because oligarchs love to oligarch,
Yeah, it's interesting that the lockdown of the economies is really exposing that layer of the Cantillon effect. I mean, we do have a real economy that manufactures stuff and creates wealth, but the financialized economy has grown bigger and bigger and starting to swamp that real economy. And you really see it. That's the heightened exaggeration of that Cantillon effect, when all there is essentially money printing for most of the world outside of, China.
Yeah, the financialization as a component of the economy for 30 years now has grown every single year. And I think it's well over 70% now if you make